No announcement was made. No grand summit ended with a dramatic signature. No headline screamed that the global monetary system had shifted. And yet, somewhere between a cargo ship changing its billing currency and a central bank quietly adjusting its reserve ledger, a different kind of settlement took place. It was a transaction that never appeared on your television screen or your trading terminal. It didn't move markets that day. It didn't crash a currency. It didn't spike volatility. But it changed something deeper, something structural. Most people think power in global finance reveals itself through big, flashy events, sanctions, interest rate hikes, trade wars, or powerful speeches from world leaders. But real power, lasting power, doesn't arrive with a bang. It arrives through procedures, through paperwork, through the boring, administrative settlement rules that decide which currency clears a trade, which asset truly extinguishes a debt, and which balance sheet ultimately absorbs the risk. And that's where the real story begins. Because long before one currency officially replaces another, before a bloc of nations announces its independence from the dollar, before all the analysts start arguing about de-dollarization on TV, something else has to happen first. Trades must still settle. Energy must still be paid for and cleared. Commodities must still be purchased. And the system quietly has to decide what is acceptable as final payment. This isn't about the currencies you can trade on an app on your phone. This is about the settlement chains, the invisible rails that run underneath all of global commerce. Think about it. Behind every barrel of oil, every ton of copper, every shipment of grain, there is a fundamental question that most people never, ever ask. What actually closes the deal? Not the price, not the invoice, but the settlement mechanism that turns an obligation into finality. That mechanism is what decides who's left holding the bag, who carries the risk when trust breaks down. For decades, the answer to that question was simple. The US dollar sat at the center of it all, not because it was universally loved, but because it was simply unavoidable. The settlement chain always led back to it. It flowed through correspondent banks in New York, through clearing systems like chips, and onto balance sheets that only the dollar could support at the massive scale required for global trade. But here's the thing about systems under pressure. They don't announce a rebellion. They don't stage a protest. They just reroute. And over the last few years, something very subtle has begun to happen across the trade corridors linking countries like Brazil, Russia, India, China, South Africa, and their partners. It's not a dramatic rejection of the dollar. It's not a sudden chaotic exit. It's a quiet, methodical redesign of how trades finish. They're building alternative settlement paths that reduce their exposure, shorten the chains of intermediaries, and shift where the ultimate risk lands. No flags were raised. No speeches warned you this was happening. But the underlying incentives changed. And this isn't really about ideology or grand political statements. At its core, it's about financial survival. It's about adapting inside a system where access to the primary settlement network has become a strategic vulnerability. When the ability to clear transactions becomes conditional, when correspondent banking relationships become fragile, when a country's hard-earned reserves can be frozen with a single keystroke, rational actors don't just complain, they adapt. They build parallel routes. They create redundancies. So, what you're about to hear is not another story about the imminent collapse of the dollar or some epic confrontation between East and West. It's a story about architecture, financial architecture. It's about how a new settlement logic is being built right underneath the existing structures, slowly, methodically, piece by piece. It grows quietly until one day, the system no longer behaves the way the old textbooks say it should. The headlines love to talk about BRICS ambition. They focus on the big political meetings and the bold declarations. But the real story is about BRICS plumbing. It's about the pipes, the wiring, the nuts and bolts of international finance. And once you see how these settlement chains are being quietly rebuilt, not to overthrow the dollar, but to strategically bypass its most vulnerable points, you'll all understand why the most important changes in global finance rarely look important at all. They look boring. They look procedural. They seem purely administrative until the day they matter. Let's dig deeper into what this plumbing actually is. Imagine you're an Indian company buying oil from a Russian supplier. In the old system, that transaction would almost certainly be priced and settled in US dollars. The Indian company's bank would need to find dollars, send them through a correspondent bank in the US, which would then clear the payment and credit the Russian company's bank, also likely through a US intermediary. This chain is long. It involves multiple parties, and every single link is subject to U.S. jurisdiction. If any of those banks fall under sanctions, the entire chain breaks. The oil can't be paid for. The new system, the one being built right now, tries to cut out that middleman. The Indian and Russian companies might agree to settle the trade in Indian rupees or Russian rubles. Or maybe they'll use a third currency, like the Chinese yuan. The payment might be routed through a new messaging system, an alternative to SWIFT. The clearing could happen between the central banks of India and Russia directly, using something called a central bank digital currency, or CBDC. Notice what's happening here. The chain gets shorter. The reliance on US-based correspondent banks disappears. The transaction never touches the U.S. financial system. For the two companies involved, it's a more direct, potentially faster, and more resilient way to do business. For their governments, it's a way to insulate their economies from financial pressure. This isn't a theory. It's happening right now. We're seeing more and more bilateral trade settled in local currencies. The creation of the BRICS contingent reserve arrangement and the new development bank are institutional pillars for this new architecture. Think of it like building a local road network to bypass a major highway that is frequently congested or has tolls you want to avoid. You don't tear down the highway. You just build alternatives that give you more options. Initially, these local roads are small and handle only a little traffic. But as more people use them, they get wider, better paved, and more connected. Eventually, a significant portion of traffic flows through this new network, changing the entire dynamic of the region. This is the real nature of de-dollarization. It's not one single event. It's 1,000 small, seemingly insignificant decisions made by companies, banks, and governments every single day. A Brazilian exporter accepts yuan for its soybeans. A Saudi oil company explores pricing in currencies other than the dollar. Central banks in Asia create a network to swap their own currencies directly without converting to dollars first. Each of these acts, on its own, is just a drop in the ocean. The dollar is still the dominant currency by a huge margin, and that's not going to change overnight. The U.S. has the deepest, most liquid financial markets in the world, and there's no immediate replacement for that. But the direction of travel is clear. The trend is not toward a single new reserve currency replacing the dollar, but toward a more multipolar, fragmented currency system. A world where the dollar is still the most important currency, but not the only option. A world where different regions have their own preferred settlement systems, their own local roads. The implications of this shift are profound, even if they unfold slowly. For decades, the dollar's central role gave the United States what has been called an exorbitant privilege. It could borrow cheaply, run large trade deficits, and wield immense geopolitical power through financial sanctions. As the world builds these bypass routes, that privilege will gradually erode. It won't disappear, but it will diminish. This process is not without its own risks, of course. A fragmented system could be less efficient and more volatile. It could create new choke points and new vulnerabilities. But for a growing number of countries, Those risks are seen as preferable to the risks of complete dependence on a single system they do not control. So, when you hear about the next BRICS summit or read another headline about de-dollarization, look past the grand statements. Look for the boring stuff. Look for announcements about new cross-border payment systems. Look for data on bilateral trade settled in local currencies. Look for agreements between central banks to establish swap lines. That's the plumbing. That's the architecture. That is where the future of the global financial system is being written, one quiet procedural step at a time. To really get why BRICS countries are changing the way they settle payments, we need to forget today. News for a moment and go back to an old idea, one so baked into global finance that we think it as a law of nature. The idea was simple. Global trade is settled in US dollars because the dollar is the most powerful currency. But that's not the full story. The dollar's dominance didn't just happen. It was engineered. The financial plumbing was built in a way that made other option almost impossible. After World War II, the dollar didn't become the world's currency because everyone suddenly trusted America. It became central because the entire system of international payments was designed to flow through one single point. The Bretton Woods Agreement set exchange rates, sure, but the real change came later. This is when correspondent banking networks, dollar clearing accounts, and a vast web of offshore dollars spread across the globe. Trade didn't just use the dollar. It was completely dependent on dollar settlement systems to finalize transactions between countries. By the 1970s, even after the U.S. dropped the gold standard, the system was already locked in. Think about it. Oil deals, commodity sales, shipping insurance, letters of credit, and bank-to-bank settlements all passed through dollar-based institutions. If Japan sold cars to Germany, the payment would often still travel through a bank's balance sheet in New York. The dollar wasn't just money. It was the master switch that allowed global trade to happen on a massive scale. This created a powerful illusion. People thought countries chose the dollar out of preference. The reality was, it was a dependency. It was a dependency created because doing it any other way was slow, complicated, and full of friction. Other currencies didn't fail to compete because of a lack of ambition. They failed because they didn't have the deep, liquid clearing systems, the legal frameworks, or a universally trusted asset to finalize payments without arguments. For decades, nobody really questioned this arrangement because, for the most part, it worked. Dollar liquidity was plentiful, access to the system was stable, and the whole correspondent banking machine ran smoothly enough. Even nations that weren't big fans of U.S. foreign policy went along with it because it was just efficient. But then, the 2008 global financial crisis happened. And that's when the first cracks started to appear. The crisis revealed something that most people in international trade had never even considered, that their access to the settlement system itself could be fragile. When dollar funding suddenly froze up, it wasn't just big banks that got hit. Trade finance ground to a halt. It became harder to get letters of credit. Banks pulled back their clearing lines. The system that was supposed to be a neutral utility suddenly showed that access wasn't a right, it was a privilege. Central banks around the world jumped in with emergency measures like swap lines and liquidity injections, but for many countries watching closely, the lesson was learned. Your access to the global financial system was not guaranteed. It could be granted, and it could be taken away. In the decade that followed, this realization only grew stronger. Financial regulations became more complex. Economic sanctions became a more common tool, sometimes applied far beyond a country's own borders. In response, big correspondent banks started de-risking. They began cutting ties with smaller banks in certain regions, not because those banks were failing, but because the regulatory risk of doing business with them was just too high. Suddenly, entire regions found their access to dollar clearing squeezed, not by market forces, but by policy decisions made thousands of miles away. This was the quiet fracture in the world of global settlement. It's the real reason countries like those in the BRICS group started looking for alternatives. Their goal wasn't some grand political statement to overthrow the dollar. It was much more practical. It was about reducing a specific vulnerability, their deep reliance on a settlement chain that could be cut off at a moment's notice. The mission wasn't de-dollarization as a catchy headline. It was simple risk management for trade flows that could not afford to be disrupted. The first steps were small and didn't make a lot of noise. Countries started signing bilateral agreements to trade in their own local currencies. Central banks set up their own swap lines with each other outside the U.S. Federal Reserve's network. Some banks experimented with new settlement methods that bypassed the need to go through a U.S. correspondent bank. None of this grabbed headlines because it didn't immediately change prices or trade volumes. On the surface, everything looked the same. But underneath, the plumbing was changing. The settlement chains were getting shorter. Instead of a payment hopping through multiple banks across the world, trades were being structured to clear within a region. Instead of holding vast reserves of offshore dollars, some systems started to net out payments locally, only converting the final, smaller balance into another currency. And most importantly, people started questioning the assumption that the dollar was the only asset that could truly finalize a payment. They began testing if another trusted asset could be used to close the loop. This is where the story pivots. It stops being just about which currency is on top and becomes a story about financial architecture. Back in the mid-2010s, while the world was focused on other things, China was busy laying the groundwork. They weren't making grand announcements. Instead, they were quietly building. They developed cross-border payment systems designed to run alongside the familiar SWIFT network. They expanded pools of their currency, the renminbi, in offshore financial centers. They started encouraging their trading partners to settle transactions in yuan. How? Not by force, but with simple, powerful incentives. Lower costs, faster processing, and better access to their massive market. Now, let's be clear. None of this was designed to replace the dollar overnight. The goal was much more subtle. It was about reducing the need asterisk for the dollar in every single transaction. Think of it like this. If you're building a house, you don't just rely on one water pipe, you build in backups. That's exactly what was happening. It was about creating options, reducing friction, and making trade just a little bit easier and a little bit less dependent on a single system. Then, in 2014, something happened that turned this quiet project into an urgent necessity. Russia faced a wave of sanctions. Suddenly, the theoretical risk of being cut off from the global financial system became a harsh reality. Access to the very banks needed to process dollar payments could, and did, disappear almost overnight. For a country reliant on energy exports, this was a disaster. Yes, they could still sell their oil and gas, but getting paid for it became a nightmare. Settlement risk skyrocketed. Delays in receiving payments weren't just an inconvenience. They became a genuine strategic threat to the national economy. The lesson was brutal and clear for everyone watching, especially within the BRICS nations, Brazil, Russia, India, China, and South Africa. The takeaway was simple. If your trade is essential to your survival, you cannot afford to have your payment systems rely on a single, external power that could turn off the tap at any moment. This experience fundamentally changed the conversation within BRICS. The discussion shifted away from lofty ideological debates and got down to the nuts and bolts. The question was no longer a philosophical one like, what currency should be the new global standard? Instead, it became a deeply practical, technical question. How do we complete a trade between two of our countries without having that transaction pass through financial checkpoints in New York or Europe that could be shut down without warning? This distinction is absolutely critical to understanding what's really going on. Currencies are powerful symbols, loaded with politics and prestige. But settlement, the actual process of finalizing a payment, is pure function. It's about getting the money from point A to point B reliably. And for these countries, reliability was now the #1 priority. They were no longer just talking. They were engineering. So, by the time geopolitical tensions flared up again in the early 2020s, a lot of the heavy lifting had already been done behind the scenes. This wasn't a sudden reaction. It was the culmination of years of quiet experimentation. Frameworks for trading in local currencies were already in place. Bilateral systems for netting out payments between two countries had been tested. Central banks had explored ways to provide liquidity to each other without using the dollar. Commodity exporters and importers, the lifeblood of many of these economies, started to get comfortable with new kinds of settlement structures, things that would have seemed strange and overly complicated just a decade earlier. While the public and the media were caught up in the dramatic rhetoric about dethroning the dollar, the private reality on the ground was far more pragmatic. The finance ministers, central bankers, and traders weren't revolutionaries trying to tear down the system. They were risk managers, desperately trying to build a safety net. They weren't trying to escape the dollar entirely. They were trying to avoid being trapped by it at the worst possible moment. And this brings us to the big misunderstanding, the lie, if you will, that many people still believe. The common narrative is that financial systems change because of grand political ambitions or ideological clashes. The reality is much simpler and much more primal. Systems change because of stress. They change because of friction. They change because of the cold, hard fear that when the next crisis hits, the old familiar pipes won't be able to deliver the water you need to survive. The first signs of this massive shift were invisible in the daily exchange rates you see on the news. They were hidden deep within the data on settlement behavior. Slowly but surely, trades that would have automatically been settled in US dollars started to be settled elsewhere whenever possible. Major energy contracts began to include new clauses, giving the parties the option to settle in currencies other than the dollar. Huge commodity deals experimented with new, creative ways to finalize payments, sometimes linking them directly to physical assets. All the while, clearing institutions in these countries were quietly expanding the types of currencies and assets they would accept for payment. Again, the goal wasn't to challenge the existing system head-on. It was simply to keep the wheels of commerce turning, even as the global environment became more constrained and unpredictable. It was about resilience. So by the time commentators started debating whether BRICS could ever replace the dollar, they were asking the wrong question. The real transformation had already happened, deep beneath the surface. The goal was never replacement. It was redundancy. Think about it in terms of technology. Your home has an electrical grid, but you might also buy a backup generator. You're not trying to replace the grid. You're just ensuring you have power during a blackout. Redundancy, once it's built into the critical chains of global settlement, fundamentally changes the balance of power. It's a change that isn't immediately obvious. It doesn't show up in headlines or political speeches. You only see its true power when the system is put under extreme stress. Because when the next shock comes, and it always does, it won't be the fiery speeches or the size of a country's gold reserves that determines who can keep trading and who gets left out in the cold. It will be the plumbing. It will be the settlement systems they have in place. We've now reached a critical point in this story. All these quiet adaptations, all these backup systems built out of necessity are starting to connect. They are crossing a threshold. A system that was designed merely as an optional plan B is starting to function as a genuine alternative. And this isn't happening because of a big announcement or a treaty signing. It's happening because the incentives on the ground, the costs, the risks, the speeds, are quietly forcing it into place. The backup generator is no longer just for emergencies. People are starting to find it more convenient to use it for everyday tasks. The big shift, the turning point everyone was waiting for, didn't arrive with a bang or a big declaration. It snuck in quietly, disguised as a problem the old playbook just couldn't solve anymore. For years, countries, especially within the BRICS sphere, had been building alternative financial pathways. Think of them as emergency exits, contingency plans for a crisis that hadn't happened yet. They tested these systems quietly, slipped new clauses into contracts, and rehearsed procedures that were rarely ever used. They were just backups, like having a generator in the basement in case the power goes out. But constant pressure has a funny way of changing things. It can turn those emergency backups into your everyday routine. And that's exactly what happened. At some point, the people managing these massive international transactions stopped seeing these alternative routes as just for emergencies. They started using them simply because they were better, more reliable, more efficient, especially when the global system was under stress. This wasn't some grand revolt against the dollar. The dollar didn't suddenly disappear. Instead, the risk of using the traditional dollar-based system quietly changed. From the outside, you wouldn't have noticed a thing. Global trade volumes looked fine, prices were stable, and container ships were still crisscrossing the oceans. Everything appeared normal. But inside the settlement desks, in the engine rooms of global finance, the math had changed. Clearing a payment through the usual dollar channels now came with a new kind of risk. It wasn't about the price changing or someone defaulting. It was about access. Would the payment actually go through on time? Would some intermediary bank somewhere along the line freeze the transaction for a compliance review? Would your funds get stuck in limbo long enough to derail the entire deal? Once those kinds of questions start popping up, the system is no longer neutral. It's no longer just a simple pipe for money to flow through. And this pressure was felt most intensely in the markets for energy and commodities, oil, gas, metals, grains. In these sectors, timing is everything. A delayed payment isn't just an inconvenience. It's a catastrophe. It triggers a domino effect. Financing gets stressed, inventories get disrupted, and trust between trading partners begins to erode. When you're facing that kind of pressure, you prioritize speed and certainty over tradition. You just need the thing to work. So the very structure of these trades began to morph. Instead of sending payments on a long, winding journey through multiple correspondent banks in different countries, they started redesigning the routes. They looked for ways to shorten the chain. They would settle payments locally whenever they could, or clear them within a regional block if the rules allowed. The whole goal was to design transactions that minimized exposure to these external choke points, these places where a payment could get stuck. The dollar was still part of the picture, of course, but it was no longer the only way. It was no longer inevitable. This is the part that most people miss. They get caught up in the idea of one currency replacing another, like a king being overthrown. But the real story wasn't about replacing the dollar. It was about redesigning the very concept of finality in finance. Finality means the moment a deal is truly done, when the obligation is paid and settled for good. The crucial question became, what asset, what ledger, what institution can we trust to finalize this deal without interruption every single time? That question became more important than exchange rates, more important than politics or ideology. And it's within this quiet redesign that things like the petro-yuan, the oil for yuan settlement mechanisms, started playing a new role. It wasn't a headline-grabbing challenge to the dollar's throne. It was a functional piece of machinery, a vital component inside new trade chains that desperately needed certainty more than they needed symbolism. Energy contracts started experimenting with this alternative settlement logic. Commodity deals began to include optional clearing paths, giving traders a choice. Transactions were meticulously structured to bypass the most vulnerable points in the old, traditional system. None of this was announced in a press conference. Nobody needed to be persuaded to do it. It just spread, organically, because it worked. It reduced friction. It solved a problem. Once a few major players, big energy companies, major trading houses proved that these new, shorter chains could function reliably, even under stress, others naturally followed. Their behavior was driven by incentives. They adopted the same structures not because of some political agenda, but out of simple, practical prudence. You have to understand, the people on settlement desks are not ideologues, they're mechanics. Their job is to make sure the machine runs smoothly. They choose the path that clears the payment fastest and with the least amount of risk. The system didn't flip upside down overnight, it rerouted. And you do see rerouting in political speeches or in central bank reserve data or in newspaper headlines. You see it in the plumbing. It's in the mundane details of how financial obligations are settled quietly, repeatedly, and without any drama. Over time, these individual choices, these small reroutings, start to add up. They accumulate. What began as an optional backup plan becomes the standard procedure. What once existed as a contingency plan for a crisis slowly hardens into permanent infrastructure. It's like a small footpath in a field. At first, only a few people use it as a shortcut. But as more and more people find it useful, the path gets wider, more defined, until it becomes the main road. By the time everyone starts debating whether a new world order is forming, that order is already operating, humming away just beneath the surface. It's working invisibly, efficiently, and it didn't ask for permission. Because that's the secret. The most powerful systems, the ones that truly change the world, don't always try to smash the old ones. To understand the BRICS settlement revolution, you have to stop thinking about currencies as just symbols on a price tag. Instead, we need to talk about three boring but crucial words: clearance, extinguishment, and balance sheet burden. These are the gears turning deep inside the global financial machine, and BRICS is building a brand new engine. So, what is settlement, really? It's not about the currency a product is priced in. It's about the final step. It's the moment an institution agrees a trade is finished, the debt is paid, and the obligation is extinguished. In the world we've known for decades, that finality almost always happens in one place: the U.S. dollar system. Even if a company in Brazil sells to a company in South Africa, the payment likely takes a detour through New York. It passes through U.S.-linked correspondent banks, gets cleared in U.S. dollars, and falls under U.S. jurisdiction. This system works because of massive pools of dollar liquidity that sit at the very heart of global trade. But here is the key point. The BRICS redesign isn't trying to blow up this system entirely. Its goal is much more surgical. It aims to reduce the number of transactions that must pass through that centralized American core to be finalized. Think of it like a highway system. For years, all roads led through one major city. The BRICS strategy is to build a network of regional highways and bypasses, so not every single car has to go through the congested and controlled city center. How did they do this? By changing how debts are balanced, what assets are accepted as final payment, and where the settlement actually happens. Instead of one long, complicated chain of transactions passing through multiple banks, BRICS-linked trades are using a layered approach. This shortens the chain and reduces exposure to any single external choke point. The core principle is simple but powerful. Separate the act of trading from the act of final settlement. In the traditional dollar world, these two things are tightly linked. An invoice is in dollars, the payment is in dollars, and the deal is only done when dollars move through the network. The BRICS alternative model breaks this link. A contract can still be priced against a global dollar benchmark, like the price of oil, but the actual payment and settlement can be rerouted. It can be cleared through a regional system, balanced out in bilateral accounts between two countries, or settled using other assets. This all happens without needing constant, uninterrupted access to the dollar system. China's role in this is not about ideology, it's about infrastructure. For over a decade, China has been quietly building the plumbing for a parallel system. Its cross-border interbank payment system, or CIPS, is a perfect example. Launched in the mid-2010s, CIPS is a messaging and clearing network that works independently of SWIFT, the dominant global system. By 2023, CIPS had connected over 1,400 institutions in nearly 110 countries, handling trillions of yuan in transactions. It's still a fraction of SWIFT's volume, but its importance isn't about size. It's about redundancy. It's a backup plan. At the same time, offshore pools of yuan began to grow in financial hubs like Hong Kong, Singapore, and London. These liquidity pools became deep enough for trade settlement. This meant a country could accept payment in yuan, knowing they could use that yuan to buy goods from China or easily convert it in an offshore market. They no longer needed to immediately cash it in for dollars. Energy trade became the ultimate testing ground for this new architecture. We started hearing about the petro-yuan, but most people missed the real mechanism. Oil contracts on the Shanghai International Energy Exchange created a brilliant new structure. The price of oil could still be linked to the global dollar benchmark, ensuring stability and familiarity. But the payment itself cleared through yuan-based channels. And here is the masterstroke. These contracts included an option to convert the yuan proceeds into physical gold through exchanges in Shanghai. This created a bridge. It linked a national currency, the yuan, to a universally accepted hard asset, gold, all without ever needing to touch the US dollar. By 2022, China's official gold reserves had climbed past 2,000 metric tons. The Shanghai Gold Exchange was trading thousands of tons annually. This wasn't just about hoarding gold. It was about creating a credible, non-dollar settlement asset. So, the petro-yuan isn't really about oil priced in yuan. It's about oil being settled through a flexible chain. The yuan acts as an intermediate step. Once a seller receives yuan, they have choices. They can use it to buy Chinese goods, they can trade it on an offshore market, or they can convert it into gold. This flexibility is what reduces the risk for oil producers. They don't have to worry about holding a currency they can't use. And they don't have to risk their payments getting stuck on dollar rails they can't control. The experience of Russia poured gasoline on this fire. After sanctions hit in 2014 and intensified in 2022, Russia's access to the dollar system was severely restricted. It could still sell its energy, but the settlement process became a nightmare of delays and frozen funds. This created enormous uncertainty. The response was a rapid shift toward bilateral settlement. By 2023, a staggering 80% of trade between Russia and China was being settled directly in rubles and yuan. Just a decade earlier, that figure was less than 10%. This wasn't a grand plan to dethrone the dollar globally. It was a pragmatic move for survival to ensure that critical exports could be reliably paid for. India added another layer to this evolving system. It expanded its own rupee-based trade settlement frameworks. This allowed certain imports to be paid for in rupees, which were held in special Vostro accounts by foreign banks in India. While the scale is still limited, these arrangements prove the concept. They show how regional currencies can be used to settle trade locally. Only the final, leftover imbalances might need to be settled in a global currency like the dollar. Each of these transactions means one less touchpoint with the centralized dollar system. So, what does this all add up to? It's not a single, dramatic event, but a slow, structural shift. We are witnessing the emergence of a multipolar financial world. The dollar isn't going away tomorrow. It will remain incredibly important for pricing global commodities and as a reserve currency. But its role as the mandatory, unavoidable intermediary for nearly every global transaction is being deliberately and methodically challenged. The system being built is more like a resilient, decentralized network than a centralized hierarchy. It offers optionality. For countries that want to reduce their dependence on a single point of failure or avoid geopolitical pressure, these new payment rails provide a viable alternative. What connects all these examples? It's something called balance sheet efficiency. Think about it. Traditional dollar settlement forces banks to keep large amounts of dollar liquidity on hand, manage credit risks throughout the day, and maintain relationships with other banks. These relationships are becoming more expensive and heavily regulated. By simplifying the settlement process and clearing transactions locally, banks can ease the strain on their balance sheets. Data from the Bank for International Settlements reveals a striking trend. The number of global correspondent banking relationships dropped by over 20% between 2011 and 2022. This is a direct result of banks trying to reduce their risk. These new, alternative settlement methods provide a way to keep trade moving without having to rebuild those weakened links. Behind the scenes, central banks are quietly supporting this new structure. They're using tools like swap lines and diversifying their reserves. While the Federal Reserve is still the main source of dollar liquidity through its swap lines, the BRICS central banks have been busy setting up their own bilateral swap agreements. As of 2024, China has active currency swap deals with over 40 central banks worth more than 4 trillion yuan. What do these swaps do? They provide emergency liquidity for trade settlement, meaning countries don't have to rely on the Fed's facilities. This reduces the risk premium that's usually built into cross-border trade. Now, let's talk about gold. Its role in this whole system is often misunderstood. It's not being used for day-to-day settlements. Instead, it acts as a confidence anchor. According to IMF data, emerging market central banks started buying a lot more gold after 2018. In fact, 2022 and 2023 saw record-breaking purchases with over 1,000 metric tons bought globally each year. For the BRICS countries, gold is like a settlement backstop. It's an asset that can be used if currency liquidity ever dries up. Because gold is universally recognized as a store of value and isn't tied to any single country, its presence strengthens these alternative settlement chains. When you put all these pieces together, the effect is subtle but incredibly powerful. Every single trade that settles without going through a dollar correspondent bank reduces the overall demand for intraday dollar liquidity. Every local netting arrangement lowers the risk of relying on external clearinghouses. And every settlement option linked to a real asset boosts confidence that debts can be paid even under stress. On their own, these changes might seem small, but together they are fundamentally changing the landscape of global settlement. What's really important to understand is that this mechanism doesn't need the kind of grand, top-down coordination that people often imagine. It doesn't require a single BRICS currency or a formal monetary union. It works because of incentives. When it becomes faster, cheaper, and more reliable to settle trades through these alternative channels, people and businesses will naturally start using them. The system evolves organically through practical use, not through some official decree. From a bird's-eye view, this is creating a layered global settlement environment. The dollar is still dominant at the core, especially for financial transactions, reserve holdings, and global funding markets. But around this core, parallel settlement circuits are forming. They're handling more and more trade that no longer needs to pass through the center. This effectively reduces the dollar's leverage over trade settlement, but it doesn't cause a collapse of its role in global finance. It's a shift, not an implosion. The potential weakness in this new architecture isn't about its scale. It's about the transition period. As more trade gets rerouted, the pools of liquidity become fragmented. The demand for dollars becomes less continuous and more sporadic, spiking during times of stress. This can increase volatility in the dollar funding markets, which, in a feedback loop, makes the alternative settlement chains even more attractive during those exact moments of instability. The system reinforces itself. This is why the underlying mechanism is so much more important than the political speeches and headlines. It explains how dollar dominance can exist alongside its declining importance in daily settlements. It explains why global trade can remain stable even as monetary influence shifts. And it explains why the most significant changes in global finance often happen quietly, without big announcements or dramatic crises. They happen through the simple logic of settlement, the incentives of balance sheets, and the fundamental question every system must face when under pressure: how do we complete the trade when the old, familiar path becomes uncertain? And when a system starts answering that question differently, again and again, the entire foundation of global finance changes into something new, something that most people don't even realize they're standing on. What everyone is talking about right now is whether the dollar will keep its top spot in the world. But honestly, that's not the most important question. The real question is, do we understand how a dominant system actually starts to fade? It's not about some dramatic challenge or big confrontation. It's much quieter than that. Systems don't collapse because they're attacked head-on. They weaken when people start to find ways around them, little by little. And the place where this bypass becomes real, where it truly matters, is in how money moves between countries, what we call settlement. Forget the grand speeches and the flashy reserve statistics. Settlement is where the rubber meets the road. Look at what the BRICS countries are doing. They're building their own settlement system. This isn't about declaring a new world order or starting a fight. It's about being prepared for a world that's becoming more stressed and uncertain. They're not looking for a showdown. They're looking for a way to keep things moving when the usual channels are constrained. And that small difference is actually a huge deal. Why? Because the biggest changes in finance don't come from a loud promise to replace the old system. They come from offering a reliable alternative when the existing system starts to hesitate or show cracks. Think about it. When the next financial pressure hits, and it always does, the big question won't be which currency is the strongest, or who has the most gold. The question that will matter to everyone, from governments to businesses, will be which payment channels are still working. Which systems can still finalize transactions without any delays or interruptions? When the big international banks get nervous, when compliance rules get stricter, when access to the usual financial networks suddenly becomes conditional instead of a given, that's when you see what's truly valuable. In those moments of crisis, the alternative systems that were once just an option suddenly become critical infrastructure. This is the reason why most people don't see this shift happening. You can't see it in exchange rates. You can't find it in the trade volume numbers. The headlines you read won't tell you how many transactions are now cleverly avoiding the old, vulnerable hubs of the financial world. But deep inside the plumbing of the system, the change is already happening. It's accumulating quietly, one transaction at a time. The pipes are being rerouted, and very few are paying attention. So the real danger isn't that the dollar will just vanish overnight. That's not how it works. The danger is that the dollar becomes episodic. It might still be desperately needed during a big crisis, but it won't be the automatic, everyday choice for routine settlements around the world. And that pattern, where the core is used less frequently but the periphery grows stronger, creates a new kind of instability. It makes the flow of money more volatile. It means we could see sudden sharp spikes in funding costs. For the powers that be, the influence they once had by being at the center of everything becomes much harder to use effectively. This puts policymakers in a really tough spot. There's no easy way out. If they try to tighten their control over the main settlement systems to maintain their leverage, they just give everyone a stronger reason to build and use alternatives. But if they loosen their grip to try and rebuild trust, they give up some of that leverage. No matter which path they choose, the global financial system is being reshaped in ways that can't be undone. Because once banks, businesses, and countries learn how to settle their payments without going through the old central hub, they don't just forget how to do it. That knowledge sticks around. It becomes a permanent part of the playbook. For financial markets, this goes way beyond just geopolitics. A fragmented settlement system means fragmented pools of money or liquidity. It means you can have a situation where everything looks calm and stable on the surface, with steady prices and low volatility, but underneath, there's a huge amount of structural stress building up. It changes how crises might happen. Instead of a dramatic, obvious crash, we might see sudden funding gaps appear in places where we always assumed money would flow smoothly. It's like a bridge that looks fine from a distance, but some of its support pillars have been quietly eroding. For anyone watching global finance from the outside, the message is simple, but it might make you a bit uncomfortable. If you're waiting for some big, dramatic moment when the system officially changes, you're going to miss it entirely. The change has already started, and it's not happening with currencies, but with procedures. It's not being announced in speeches. It's being recorded in ledgers. It's not a revolution. It's a rerouting. In today's financial world, real power isn't about who makes the loudest declarations. It's about where payments are finalized, where obligations are settled, without a shadow of a doubt. Every single time a trade is settled successfully outside of the traditional channels, the map of global finance shifts just a tiny bit. It's not enough to notice on its own, but when you add up millions of these transactions, it fundamentally changes the landscape. This is exactly how underground or alternative systems work in any context. They don't try to replace the official, visible system right away. They just offer a quiet, reliable support structure. They operate in the background until one day the main system becomes dependent on them without even realizing it. By the time that dependency becomes obvious to everyone, the underlying architecture has already been completely rebuilt. The foundation has been switched out from under the house. The new settlement chains being built by the BRICS and other nations aren't just a prediction of what might happen tomorrow. They are a direct response to a world where tomorrow is becoming more and more uncertain. They are a sign of how systems adapt when they can't take the future for granted. And once you really grasp that, you start to see global finance differently. It's not just a competition between currencies like the dollar versus the yuan. It's a competition of clearance. It's a race to see who can provide the most reliable plumbing. Because at the end of the day, when things get tough, the system that survives and thrives isn't the one that makes the most noise or has the most impressive sounding name. It's the one that still clears the payments when the lights go out. It's the one that keeps the machinery of the global economy turning, no matter what shocks come its way. That is the ultimate test of resilience, and it's a test that's happening right now, quietly, in the background of our interconnected world.